This is Nightly Business Report with Tyler Matheson and Sue Herrera.
In transition, growth in China, the world's second largest economy, may be slowing now, but does the pause pave the way for future expansion?
Silver lining, why it's the best time in a long time to be an American consumer.
And don't get duped. The IRS warns of an age-old tax scheme that is finding new victims. All that and more tonight on Nightly Business Report for Tuesday, January 19th.
Good evening, everyone. I'm Sharon Epperson, in tonight for Sue Herrera.
And good evening from me as well. I'm Tyler Matheson. Well, it was the rally that wasn't. Just when it looked like the market might have a chance for a triple-digit gain, things reversed. The reason? Oil prices. And just like that, the air came out of stocks. After being up more than 180 points, the Dow Jones Industrial Average closed with a modest 28-point rise to finish at 16,016. The Nasdaq fell 11 and the S&P 500 gained a single point. As for oil, domestic crude settled down more than 3% today to $28.46. Bob Pisani has more on today's vanishing rally.
It was another up and down day, but overall it was disappointing for the markets. Now, on the surface, it's simple. There's no peace in the stock market without oil coming down. Oil broke down twice today, right after the open and then again in the middle of the afternoon. Both times, the stock market followed down. Today was a little more important for technical reasons as well. The minute the S&P 500 broke through 1880 in the afternoon, that was the closing low on Friday. The market took a leg lower on heavier volume. The market took another leg lower when it broke through 1867. That was the low for the S&P 500 in August of last year. Stocks rose after oil stabilized late in the day, but not after a lot of damage was done. Big oil names like ConocoPhillips were down 7%. 7%. Hess was down 6%. Murphy was down almost 5%. But Exxon was only down 1.5%. It seems almost immune from the big drops its fellow oil companies have been seeing. Now, you may also be wondering, why are the technicals suddenly so important? When traders don't understand what the fundamentals are doing, and they are certainly confused right now, they turn to technicals because it gives them some signal on what to do. Traders, after all, trade for a living. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As Bob just reported, stocks followed oil prices lower, pressured in part by a report from the International Energy Agency that said the market could, quote, drown in oversupply. And as Jackie DeAngelis reports, supply is only expected to grow now that sanctions on Iran are being lifted.
After a 40% drop in oil prices over the last 12 months, investors were starting to think that a bottom was in sight. But opinions have changed after it was announced that sanctions against Iran would be lifted and that Iranian oil would come to market. Consensus estimates are calling for the Iranians to add about 500,000 barrels of capacity per day fairly soon, in an environment where OPEC is already producing at record highs.
Bottom line is there's too much oil on the world as it is, and the Iranian supply will just add to the price pressure. The world just can't absorb it. It's that simple. Unless the U.S. production drops by the same amount the Iranian production is increasing, then we will see prices pressure.
And it's not just about capacity, it's about market share. Remember, Saudi Arabia's strategy has been to keep producing oil and roll with falling prices. The Saudis even discounting their oil in the past as part of their strategy. But today, reports that Iran will discount as well, triggering fears of a price war.
I could definitely see a price war between the Saudis and the Iranians. Number one, because the Iranians, by having their oil off the markets over the last few years, have lost a lot of market share. They need to regain that back. And the way they can is by reducing prices. So they're going to do that. The Saudis have plenty of oil they're producing that they can't get rid of. They're going to reduce prices. And we already know that some grades or blends in the U.S. are actually trading below the screen too. So there's an all-out price war.
The supply side of the story continues to be one of a global oil glut. Now there are concerns about the demand side as well. The International Energy Agency saying today it's keeping its demand forecasts flat. Couple that with volatility and concerns about what's happening in China, and the demand picture is bleak. Supply and demand continue to diverge. What will happen to oil short term? As it holds under 30, it could skid to 27 pretty fast. For Nightly Business Report, I'm Jackie DeAngelis.
The Chinese economy grew at its slowest pace in a quarter century, though at a rate many countries would envy. China reported GDP of 6.9% growth last year. That was just below the government's target of 7%. It was down from a year earlier. But the report also revealed something new. For the first time, services accounted for more than half of China's economy, while manufacturing's share fell. And as Eunice Yoon reports from Beijing, the consumer-based shift could lead to greater growth in the future.
Xu Tiling is a new face in China's new economy. The 22-year-old used to work at a factory. But today, at the Beijing headquarters of this internet company, Xu waits to deliver food for customers who place orders through an app on their mobile phones. I worked in a factory for many years. It was so boring, he says. I found I really like this. Xu has joined a part of the economy that the government hopes will drive China's growth. Services like logistics, travel agencies, retail shops, restaurants, hotels, and IT.
As Chinese people become wealthier and get busier at work, they don't have the time to do everything that they might have done on their own. Cook food, for example. So that spawned a massive need for services like food delivery.
After a long discussion, we selected Tongguo as the logo.
Meituan is an online booking site offering group discounts like Groupon in the U.S. and food delivery. Manager Wang Huiwen expects that by 2020, Chinese consumers will place 30 million orders for meals a day via companies like his, almost 4 times what they do today. Delivery services in the U.S. started from a phone call. In China, it's begun with an app. Mobile apps are a relatively new area, so there's room to grow, he says. Wang says his industry is attracting heavy investment and hiring fast. Services now account for a larger part of China's growth, 48.2% compared to 42.6% in 2014 from traditional drivers like manufacturing and construction. But the question is whether these new types of businesses can develop fast enough to drive the economy forward as old industries fade away. Xu isn't concerned. This business is going very well, he says. I think delivery services have a bright future. If Xu is right, so could China. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Well, consumers here at home have a number of things working in their favor. Gas prices are low, the job market is strong, and home values are rising. Steve Leisman has more on the silver lining over Main Street's economy.
The International Monetary Fund marked down the global economy Tuesday, mostly a result of lower oil prices hitting growth in emerging markets. But what it didn't do was mark up the advanced economies or growth among consumers of those cheaper commodities. For the U.S. consumer, cheaper oil prices have meant lower inflation and increased buying power. Data to be released by the government tomorrow should show that real or inflation-adjusted wages for average workers in 2015 had their best year since the recession ended. The consumers also benefited from strong job growth and decent home price appreciation, leading to brighter views on the economy among the public. But while the IMF slashed its 2016 forecast for oil-soaked economies like Russia and Saudi Arabia, it also downgraded the U.S. by 0.2 to 2.6% from 2.8%. And the IMF chief economist even said that he thinks markets are overlooking the silver lining from the decline in oil prices.
There are still positive effects on consumers and on companies that rely on energy for their production processes and are benefiting from lower production costs.
Market pros caution against mixing up the U.S. economy and U.S. financial markets. They're separate, they say.
The U.S. economy in a global setting is unique. It's the most closed economy, meaning it's the least dependent on the rest of the world. The rest of the world means less for the U.S. economy than the U.S. economy means for the rest of the world. But when it comes to financial markets, the financial market linkages are much greater. The U.S. financial market sensitivity to external events.
That means worries about China and oil prices can and probably should bring down U.S. stock prices, and they have. But it's not entirely clear that should mean a markdown in U.S. growth or worries about recession. At least since the Great Recession, these are some of the best times for the U.S. consumer. For Nightly Business Report, I'm Steve Leisman.
As the Obama era comes to an end, there may indeed be reasons to cheer the U.S. economy. After all, it is, by most measures, in a better place now than it was when the president took office. But just how much better, or whether it's better at all, often depends on one's politics. John Harwood joins us from Washington. John, if you listen to the candidates on the right, you'd think the economy was in horrible, or Donald Trump's favorite word, terrible shape. If you listen to some people on the far left, you would think it was failing too, or at least failing big segments of the population, but for different reasons. Does anyone speak for a moderate Main Street?
Well, the problem, Tyler, is that we've got two different economies, of course. We've got an economy that has been pretty good at delivering rising stock prices, corporate profits, but people in the middle of the income spectrum have not been moving ahead. So a lot of the people you see complaining on the extreme right and the extreme left are looking at those results rather than what's happening in boardrooms or on Wall Street.
John, is this different than the way we thought about economy in the past? Has the partisan view changed either for Republicans or Democrats when it comes to their views of the economy?
You know, it is different now, and here's the reason. Our politics have gotten terrifically polarized now between left and right, Republican and Democrat. And what happens is when you ask people in polls to assess the economy, that's a bit of a proxy for how they feel about how the country is going. And if their side is leading or is in control of the Congress or the presidency, that may color their response. If you're a Democrat and Barack Obama's in the White House, yeah, you think the country's going pretty good, and you'll say that even about the economy. The reverse for Republicans, and this is something that we've seen over and over, and it's one of the reasons why pollsters tend to discount somewhat people's assessments of the economy itself, because it's simply another way of asking about your partisanship.
All right, John, thank you very much. John Harwood with analysis from Washington.
So how do you feel about your economy? We took our cameras out to see what you had to say.
Gas is cheaper. We're able to go further on the weekends. I'm buying my lunch as I always do. I'm an Uber driver as well as a regular, just 9-to-5 worker, so it kind of makes it easier. More people are catching, Ubers, more people, are out there, so therefore I can drive around more people. Gas prices are lower, so therefore I can drive around longer.
We bought a new house, or a new condo 4 years ago.
Yeah.
And I think that the low interest rates and the lower housing prices helped us a ton.
I think they bought a new igloo. All right, as you've just heard, there are many different views on the state of the economy, from Wall Street to Washington to Main Street. Everybody has an opinion, but who's got it right? Craig Dismuke is chief economist at Vining Sparks, an investment firm in Memphis. Craig, welcome. Good to have you with us, and welcome to Nightly Business Report. How do you think the economy is doing, and how do you think the average guy or woman is doing?
Well, I think you can look at it from either side, and obviously from a political perspective, it's spun in different ways. But when you look at the economy just at the numbers, I think it's an underperforming economy. We're growing at a rate of 2%. It's not what it's been historically. But at the same time, we've certainly made a lot of progress since 2008, when we were in the middle of the financial crisis.
When you're looking at the job growth that we're seeing, Craig, or in some parts of the country, the lack of job growth, is it the fact that jobs just aren't compelling? We have seen, of course, an improvement in the unemployment rate, but a lot of folks say that really doesn't apply to me.
Sure. Well, the types of jobs that we're creating aren't the types of jobs that are really the high-paying jobs. So you've got really two factors that are in play. Number one, we're creating more jobs that are part-time. The number of full-time jobs haven't come back all the way to where they were prior to the recession. And then the second issue is that a lot of the jobs that are being created are in low-paying industries. So, for example, we're getting jobs in retail and leisure, healthcare, education. We're not getting jobs in the higher-paying sectors like utilities, finance, IT, et cetera. So, we're creating more part-time jobs rather than full-time jobs, and we're also creating jobs in lower-paying sectors or industries than we are high-paying industries.
Why, Craig, you say the economy is underperforming. Why do you think that is the case? And is it reasonable to expect that our bigger, more mature economy would still grow at rates like we might have seen in the 50s, 60s, even into the 90s?
Right. So the average rate of growth historically has been between 3 and 3.5%, and we're closer to 2 now. I think it's a great point that as a mature economy, but more importantly, as an aging population. So we have an aging demographic, and it's something that economists continue to discount and not factor in. The reality is, as the population ages, that they spend differently. And as they spend differently, you're not going to get the type of consumption or economic growth that you've had historically. So I think that's one of the factors. The other factor is we've just come out of a very deep recession. And when the natural response to that is to have a big onslaught of new regulations. And so the business community is saying, all these new regulations make it harder to do business. And so that's another thing that's weighing on growth.
Interesting analysis. Craig Dismuke with Vining Sparks. We'll have you back again soon. Thanks very much.
Well, thanks, Tyler.
And still ahead, Big Blue bruised. IBM may have topped expectations, but are shareholders questioning the CEO's long-term strategy? Netflix, the top-performing stock in the S&P 500 last year, topped Wall Street earnings estimates and added more subscribers than many thought. The video streaming service earned 7 cents a share, beating the 2-cent estimate, and revenues for the quarter were roughly in line, up more than 22% from a year ago. That helped send shares higher initially in after-hours trading. Julia Borston takes a closer look at the Netflix report.
The most important takeaway from Netflix's better-than-expected earnings report is that the company is growing far faster than expected overseas. Netflix adding a record 5.59 million new members in the quarter, over 4 million of them coming from international markets. This as the company completes its global rollout faster than expected, with the company recently expanding its potential subscribers to another 190 million homes with broadband all around the world. Netflix also raised its expectations for how many overseas subscribers it'll add this quarter, higher than expected. But Netflix's new international growth will not come from China. The company says it still has work to do before it can launch there. Back over to you.
Julia Borston reporting. IBM also reported better than expected earnings late today. Big Blue pulled down $4.84 a share. That beat forecast by 3 pennies. Revenues, though, fell for the 15th straight quarter, despite coming in just above expectations at roughly $22 billion. The stock made just fractional moves initially in extended hours trading, but those moves were lower. The big question for long-term shareholders who have seen the stock slide more than 30% over the past 3 years is, what's the CEO's strategy, and is it working? Josh Lipton tells us.
IBM's CEO, Ginni Rometty, has staked her company's future on fast-growing areas such as cloud technology, where she is dedicating a lot of time, resources, and money. She calls it strategic imperatives. IBM now boasts a more than $10 billion cloud business. Other strategic imperatives include security as well as social and mobile technologies. Together, IBM says 40% of its overall business will be in these emerging growth areas by 2018.
If you look at it, the tech landscape is broadly changing. Customers want to use the tech products in a different way than they used to. They want to rent things instead of buying them. They want to have a subscription model versus owning the asset outright. And as that tech consumption is changing by the customers, IBM has to evolve into newer ways to sell these solutions and products to their customers.
The dilemma, though, is that these new areas of growth aren't big enough yet to offset the challenges facing the company's traditional businesses like packaged software, services, and hardware.
The challenge IBM has is this traditional legacy stuff is higher margin, higher free cash flow for IBM versus the new strategic stuff. And as they go through the transition, you have headwinds on free cash flow, headwinds on the EPS numbers.
That's why investors have been skeptical. Since Rometty became CEO in January 2012, IBM stock is down about 30% versus a gain of nearly 50% for the overall market. But that is why bulls say IBM is now a buy. They argue that it's a contrarian play given how negative Wall Street is about the company's prospects. Only some 30% of analysts are telling their clients to invest in Big Blue. Bulls also argue that the stock is cheap and the company pays a dividend. In other words, investors are paid to wait. Still, skeptics like Daryanani remain on the sidelines. He says he'll get more optimistic about IBM when those strategic imperatives approach 50% of total sales, or Remedy does a big acquisition that boosts all those new business lines. For Nightly Business Report, I'm Josh Lipton in San Francisco.
The nation's largest health insurer sees a drop in profit but still beats expectations. And that's where we begin tonight's Market Focus. United Health Group says earnings in its Optum Pharmacy Benefit Management unit rose 50% in the quarter. But the company's operating earnings from its main United Healthcare insurance business were cut nearly in half. Shares of United Health ended the day up 3%, though, to $112.58. Bank of America posted its best full-year profit in nearly a decade, thanks in part to a better-than-expected quarterly earnings report. The second largest bank in the country was helped by a drop in legal costs. Bank of America said that revenue growth remains, though, challenging. Shares of B&A were off about 1.5% to $14.24. And shares of Morgan Stanley rose after the bank beat analyst targets. The company said it cut 1,200 jobs in its fixed income and commodity units last month as part of a plan to reduce $1 billion in costs by 2017. Morgan Stanley rose about 1% to $26.26.
And Sharon, another activist has taken a stake in Macy's. Greenlight Capital's David Einhorn disclosed a position in the company and said it could be a takeover target. Greenlight also wants the retailer to unlock the value of its real estate. Macy's has been under pressure from another activist firm, Starboard Value, to spin off its real estate holdings. The stock up 2% to $38.76. Tiffany, however, lowered its earnings outlook for the year following soft holiday sales. The luxury jeweler says the strong dollar is eating into foreign tourist spending. The company is also cutting jobs, but declined to say how many. Shares off 5% to 64.22. The Dow component Johnson & Johnson says it will cut about 3,000 jobs in its medical devices unit. That amounts to about 2% of its global workforce and would save roughly $1 billion in annual costs. Shares of J&J up fractionally to $97.50. And Delta missed earnings and revenue estimates in the fourth quarter, in part because of the strong dollar, but the airline did save more than $5 billion on fuel last year, and it expects profit margins to improve in the current quarter. Shares were 3% higher at $45.95. Coming up, don't get scammed. The Treasury Department issues a big warning to taxpayers.
Here's a look at what to watch tomorrow. Dow component Goldman Sachs reports earnings before the opening bell. The Consumer Price Index, a key measure of inflation, is due out. And we'll have a report from the 45th World Economic Forum in Davos, Switzerland, where business and political leaders are discussing the global economy. That's what to watch for Wednesday.
The Supreme Court has agreed to rule on President Obama's new immigration plan. The proposal would shield more than 4 million people from deportation, but it was blocked by lower court rulings in a lawsuit brought by Texas and 25 other states. Oral arguments are set for this spring. A final decision could come at the end of June and just before both political parties' 2016 conventions. The court also said it will review an insider trading case related to a former Citigroup trader. At issue is whether prosecutors must show that the insider received a concrete benefit in exchange for passing on the information.
Okay, temper your excitement. Today marks the first day of the 2016 tax season. But now, before you file, the Treasury Department has a warning for all taxpayers. Beware of scammers. Eamon Javers reports.
The IRS is calling me? Is this for real?
Fraud is real.
A new series of public service announcements is warning Americans of an age-old tax scam that's taking more and more new victims to the cleaners. In the scam, criminals call American taxpayers pretending to be IRS agents and demand phony back taxes. Often, the criminals threaten to call the police if the taxpayer hangs up the phone.
It makes me angry because
I feel, first of all, bad for the victims. And then I feel angry that these criminals are using the IRS as a means to scare people into paying them money.
The Inspector General for the IRS says as many as 5,000 victims have paid as much as $26.5 million to the scam artists, who can be located inside the United States or around the world.
The scam began by targeting new immigrants to the United States and threatening deportation and other penalties. But the Inspector General says it has since mutated and now is targeting every demographic group.
Early in the scam, the callers had some sort of information about you. They may have 4 digits of your social security number. Now they're just randomly making blanket calls. And they've also shifted now to also calling cell phones.
El fraude es real.
That's why the agency has released 5 new videos in both English and Spanish telling people that the IRS will not call you out of the blue and threaten to arrest you. And the government has one piece of advice for anyone getting such a call.
Hang up on fraud. You can't be tricked into giving personal information if you hang up the phone, and you certainly can't be tricked into paying them money, harassed or intimidated into paying them something if you simply just hang up the phone.
But what if the caller really was from the U.S. government? Well, the Inspector General says not to worry. The IRS won't be offended if you hang up on them. For Nightly Business Report, I'm Eamon Javers in Washington.
And it's important to be wary of emails too. You know, make sure
They're
that
phishing
they're really
to find out
to find out information about you. So be very careful.
And prey on the elderly, as often is the case.
Absolutely, absolutely. That is it for Nightly Business Report tonight. I'm Sharon Epperson. Thanks so much for watching.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everyone. Stay warm. We'll see you tomorrow.